So shall we start?
Yes, we can start.
Hello everybody, this is CA Pooja Rathi and I welcome all of you to today's webinar. Before starting the webinar, let me introduce you to our today's speaker, Ravi Kumar Somani sir. Mr. Ravi Kumar Somani is a qualified chartered accountant who is extremely passionate indirect tax professional with experience in performing health check reviews, providing advisory and litigation support in the matters concerning indirect taxes. Ravi sir has delivered lectures at various trade and professional forums such as ICI, CII, National Insurance Academy, and many more. He has also co-authored books on indirect taxes like Practical Guide to GST Audit and Certification, published by Bloomsbury, Self-Study Guide to Indirect Taxes, published by Asia Law House, and Practical Guide to GST on Automobile Industry. Ravi sir has also written various analytical and issue-based articles, research papers, and legal updates on indirect tax matters, which are published in various newsletters and online platforms. He loves doing extensive research on the subject and solving critical indirect tax problems. His mission is to spread indirect tax knowledge, solve indirect tax problems, and to raise voice against unscrupulous practices. I'm sure everyone must be eager to listen to our today's speaker, and hence without taking further time, I request Ravi sir to enlighten us on today's topic. Also a request to everyone, please drop your questions during the session in a chat box so that sir can answer all the questions at the end of the session. Over to you, sir.
Thank you very much, Pooja, for the introduction. So welcome everyone. I hope I am properly audible. Pooja, if you can just confirm to me on that.
Yes, sir, you are clearly audible.
Great. So welcome everyone. Today's topic is changes in GST effective from January 1, 2022. Although generally when I take sessions, I prefer to have the Q&A session simultaneously, make it more interactive. But today's topic is quite vast and a lot of amendments that are there which are effective from 1st January, which we all need to cover it up in this process of our deliberation. So I suspect that making it interactive may lead to delay in sessions. So what we would do is that whatever queries that you have, please put it in the chat box. In the end of the session, we will take time for Q&A, especially for answering various queries. In case we are unable to answer, then we will still try to resolve the queries. You can just send an email to us or call us. We'll resolve the queries whatsoever are there in relation to the topic of today's discussion. So, as we all know that there have been multiple changes that have taken place that are effective from January 1st, 2022. The biggest change is in the context of input tax credit as to what is the methodology that one needs to follow as far as taking the credit is concerned with new section getting effective under the Cgst Act plus amendment in Rule 36(4). Most importantly, these amendments have taken place, I would say the notification has come about 10 days before the change, maybe I think around after 20th of December. So it's a very, very small window of time which has been given to businesses to really understand these amendments and to implement them. But then most of the things were known that it is going to come because this was already brought out in Finance Act 2021. Of course, preparedness could be a challenge, but then we will see in today's discussion as to what are the practical challenges that would come and how do we really address them. So today's session will be covering I would say if I have to break it up in two different topics. One is general amendments applicable to all. Now in this, there are a host of amendments that have taken place that are applicable to almost all the industries, which are more related to returns filing, input tax credit, e-way bill, and so on. There are some amendments that are applicable to specific industry or specific sector. So what we have done is that we have broken the entire discussion in these two parts. So most likely the first half of the session would be on the general amendments that are applicable to all. Second half would be sector-specific amendments. For example, amendments in the association clubs sector, then passenger transportation, restaurants, government projects, infrastructure industry, textile, footwear. So those are very sector-specific amendments. So the idea was a particular person who does not really want or deal with those sectors, they can actually continue the session only for that academic purpose. Otherwise, they can also look at exiting from the discussion. This was the idea of structuring the session in this particular manner. So without taking any further time, let's go ahead into the topic. First and foremost discussion, which is also one of the most important discussion of today's session, is ITC matching with respect to Gstr 2B. Now, as far as input tax credit is concerned, there are multiple changes that have been happening on this line more specifically right from the time GST got implemented. July 2017, we were all kind of getting ready so that GSTR 1, 2, 3 would be there, and we'll have to do the dual level of matching and all these things. But it was more of in the books, which never got implemented. Government tried hard to implement it, but somehow I think there are a lot of limitations in that. Of course, it was also kind of a tough call for them to implement such a big change. So somehow it did not happen. Then in the middle of the period, I think there was a lot of talk about the new returns coming in. In fact, we did a lot of seminars on new returns. Of course, the new return never again saw the light of the day. So July 2017 to October 2019, 8th October 2019, effectively, there was no provision in the Act or in the rules which was notified and which was working effectively to really give effect to the matching. Because what was talked about as far as matching is concerned in section 42 and 43 was never made effective in the manner in which it was provided in the law. So effectively, the condition in section 16(2) was not at all there. Further, there was no rule giving effect to the single level matching which was brought out by the law by way of GSTR 2A. So in a way, I can say that up to October 2019, that is 8th October 2019, there was no system of matching. There was no mechanism in the either Act or the rules to really give effect to the single way matching which the government is proposing to bring. They have realized that this is a problem in the law. So then 9th October 2019, out of desperation, without even going by notifying a section or giving a power in the Act, they went ahead and amended Rule 36(4). And we all know then this two-way matching started, which was like initially there was 20% of buffer which was given, which was reduced to 10%, which got further reduced to 5%. But then the important question is, while Rule 36(4) is a rule, which provision under the GST Act, that is Cgst Act or Sgst Act, really gives power to the government to have Rule 36(4) in place? If you ask me, there was only one section which gave this power, which was section 43A of the Cgst Act. Unfortunately, 46A was never notified by the government. It was never notified. Even today, 43A is as it is there, it is not notified. I don't think they are anyway going to notify 43A. Which means Rule 36(4) was followed by industry trade professionals only as a matter of abundant precaution. Why to unnecessarily litigate? Let us comply with GSTR 2A. This is what the suggestion we used to give to all our clients. And we thought, we should take a conservative view because a lot of problems were faced in the VAT regime and, erstwhile VAT regime where matching was always there. So this was a conservative view taken and this was followed. But let me tell you, in the VAT, there was a proper legislative framework which is not there in the GST law. In a way, Rule 36(4) was an excessive delegation, which means it was made in the GST rules as an amendment in the GST rules without there being any power in the GST Act to really have that particular rule being notified. Then they realized this problem that yes, there is a rule with no power in the Act. That is where this amendment was brought out in Finance Act 2021, wherein they have inserted section 16, subsection 2AA. In the middle, before that, from January 1, 2021, they brought this concept of 2B. Now, nobody knew from where this 2B has come. Again, let me tell you, 2B also did not add any head or any tail. In fact, it's only a facilitation. I'll tell you, recently a Supreme Court judgment in the case of Bharti Airtel, wherein it was clearly mentioned by Supreme Court of India that Gstr 2A is merely a facility, because there is no provision in the Act. To bring a provision in the Act, this section 16, subsection 2, clause AA was brought by Finance Act 2021. Let me tell you, this provision was brought way back in January 2022, but then it is made, January 2021, but it is made effective from 1st January 2022. The reason being, under GST law, I would say, we need all the states to also come on board so that it is passed in all the state legislations. Only then a law can be implemented. Generally, it takes 1 year. Any change in a budget, what we have been seeing from the past history is it takes 1 year to implement any change in the budget. So this was brought in Finance Act 2021 right in February 1, 2021, but almost now, that is 1st January 2022, this would be implemented. So the important question that comes now is that after this provision coming in the Act, that is 16(2)AA, now whether we can say that GSTR 2A or GSTR 2B is having a validity, legality, and do we need to strictly comply with GSTR 2A, 2B, or how do we really proceed as far as input tax credit is concerned? So what we would do is that firstly, I would like to make you go through the exact provision verbatim as to what it talks, GS 16(2)AA and Rule 36(4). And then we'll first try to understand the legality of this particular provision. And then we would go into the practicalities of how do we really implement this particular provision. Now, as far as 16(2)AA is concerned, this is the wordings which has been implemented from 1st of January 2022. It says the details of the invoice or debit note referred to in clause A, that is, input tax credit, has been furnished by the supplier in the statement of outward supplies. Let me tell you, statement of outward supplies, nothing but it is a GSTR 1. And such details have been communicated to the recipient of such invoice or debit note in the manner specified under section 37. We need to understand that it must be communicated in the manner specified under section 37 of the Cgst Act. Now here, first and fundamental aspect, we need to understand that section 16, subsection 2, subclause AA only covers invoice and debit note. It does not cover bill of entry, which means we take input tax credit on the import transactions under the cover of a bill of entry. Bill of entry is not covered under 16(2)AA. Second important thing is that distribution of credit by way of ISD is also not covered under this particular transaction in this particular statement. It also does not cover transactions which are under reverse charge, where you are taking input tax credit on the taxes that you have paid under reverse charge. It also does not cover the transactions which are by way of a credit note. So what is covered is invoices and debit notes. It does not cover ISD, bill of entry, reverse charge, and credit notes. the important question that comes is that how do we have two different mechanisms that are required to be followed for certain types of credits and a separate mechanism for certain other type of input tax credits? That is one big problem that is going to come. Now, subject to this 16(2)AA, this rule was brought in, that is Rule 36(4) as amended. Now, I am referring to the amended rule rather than the erstwhile rule. The erstwhile rule talked about Gstr 2A. No input tax credit shall be availed by a registered person in respect of invoices or debit notes. Again, it talks about invoices or debit notes, the details of which are required to be furnished under subsection 1 of section 37, which is Gstr 1, unless the details of such invoices or debit notes have been furnished by the supplier in the statement of outward supplies in form Gstr 1 or using the invoice furnishing facility, which is also called as IFF. The details of such invoices or debit notes have been communicated to the recipient. So there are two things. One is it must be furnished by the supplier. It must be communicated to the recipient, that is the registered person, in form Gstr 2B under subrule 7 of Rule 60, which means I deliberately wanted to read this provision verbatim so that you know what is the law. Once we know what is the law, then it is easy for us to interpret the provisions of the law. The matter of the fact is that Gstr 2A now does not have any relevance, because the entire reason why we were following Gstr 2A was because it was given in Rule 36(4). In the revised amended Rule 36(4), I do not see any reference of Gstr 2A. Rather, what they have referred in revised Rule 36(4) is Gstr 2B, which means Gstr 2A is now died. It does not have any relevance going forward, effective 1st of January 2022. What is more important to be looked at is Gstr 2B and not Gstr 2A. Very, very, very important point that we must be noting. Next, very, very important aspect, what has been brought out here is that in the manner specified under section 37. Now, when I really go into the manner what is specified under section 37, it also talks about the recipient uploading the invoices as referred under section 38. When we really go into the details of section 37, when I look at other relevant provisions in the Cgst Act, that is section 38, 39, and 42 and 43 of the Cgst Act, which are still the provisions of the Act effective as on today. There is a system wherein the matching power is also given to the recipient. Let us say as a recipient, as a customer, I see that any invoice is not uploaded by my supplier. There is a concept of customer uploading that invoice so that supplier accept it and we can take the input tax credit of that invoice. This is a procedure or a provision which is there in the Cgst Act, and till date it is continuing as a provision in the Cgst Act, and the same is not been I would say deleted or removed from the law. Important question that comes is that how do we interpret this entire anomaly that is created now? In one way, there is section 16 subsection 2 clause AA, which talks about taking credit in a particular manner, referred through Rule 36(4), and then there are a host of other sections which are still effective, talks about recipient to upload the details and take input tax credit, but that particular entire mechanism is not yet made effective. So when there are two divergent provisions going absolutely in a opposite direction, how do we interpret the provisions of the law? It has to be given a harmonious interpretation. This is a general rule of interpretation that each and every provision, each and every word, each and every connotation or a grammatical symbol in the law has a meaning. It cannot be read as a dead letter. It cannot be ignored. In a way, what government is now asking assessees to do is you look at only 16(2)AA and you ignore section 38, you ignore section 39, you ignore section 42, and you ignore section 43, which are even the provisions of the Act as on today. So in my view, this is not correct, and this is going to lead to absolutely absurd results, because there is a provision in the Act which is giving the power to upload the details to the recipient, but the same is not being notified or not been made effective by the government as of today, while there is an Act which is there. So one has to do a harmonious interpretation of the provision given in the law, and this is straight away leading to impossibility, because as a recipient, I am not given with the option to upload the invoices which is there as a provision in the Act. This is point number one. Point number two, what we need to understand is that this 16(2)AA is not made applicable to bill of entries, ISD transactions, RCM transactions, and to credit notes, which means it clearly goes against the very fundamentals of right to equality. If you are doing an import transaction, if you are purchasing a material from outside India, you don't have any hassle of doing matching. You can take the input tax credit based on bill of entry. You need not look at Gstr 2B or Gstr 2A or anything. In fact, there is no time limit to take input tax credit. But when you are doing a purchase from a domestic supplier, then you have all the restrictions to take input tax credit. This is the fundamental thing that comes out. In my view, this clearly goes against Article 14 of the Constitution of India, right to equality. Although under Article 14 of the Constitution of India, when we look at real interpretation, government can always do an intelligent differentiation between certain transactions. But from no stretch of imagination, I can see this as an intelligent differentiation. First of all, there is a differentiation, but is it an intelligent differentiation? I mean, which law book or which policy would be such that would benefit the imports and against the domestic suppliers? Are you getting it? This clearly goes against the very fundamental thing which government is looking of Make in India. What I am assuming is that they must have totally missed out while amending section 16(2)AA. This particular aspect. Possibly this would be amended in this budget, that is Finance Act 2022, which will get implemented in again January 2023. Then we will have one more webinar at that point of time to see whether now at least they have really taken care while implementing this particular provision. But as of today, it clearly goes against right to equality. I do not see any intelligent differentiation over here. There are a host of Supreme Court judgments on this particular aspect. We'll go into that one by one. But before that, I would like to bring out one more problem that the government has done by bringing out this Gstr 2B, is that there is an unjust profiteering by the government in this entire scheme of things. For example, on a 100 rupees transaction, government is saying that the recipient would not be eligible for input tax credit if the supplier has not uploaded the details in Gstr 1. It is not reflecting in the Gstr 2B of the recipient. Recipient would not be eligible for the input tax credit, which is fine, no problem. Recipient will not take that input tax credit. Once recipient has not taken the input tax credit, government has already received 18 rupees of GST on a 100 rupees transaction, correct? Which means government should not chase the supplier government should not demand this money from the supplier. But however, what government is going to do, they are going to keep both supplier and recipient blindfolded. Nobody knows what is happening. The same 18 rupees government is also going to collect from the supplier because they have all the powers under section 73, 74 and various other sections to demand and recover the 18 rupees even from the supplier. So what is happening? On a same 100 rupees transaction, recipient is not taking input tax credit and the supplier will also end up making the payment to the government of 18 rupees. When the supplier is going to make the payment to the government, there is no mechanism to pass back that input tax credit to the recipient. In the process, 36 rupees of GST would be collected by the government on a 100 rupees transaction. I'm not into interest penalties and other things that they are then going to collect again from both the parties. This, in my view, is clearly undue profiteering from the government out of taxation. If you ask me why the GST collections are 1,30,000 crores, I will tell you that the 30,000 crore extra is only because of this, match mismatch. That is the additional revenue which government is collecting. In my view, it is absolutely frustrating the very objective statement of object for which the GST was implemented of not having cascading of taxes. And by no stretch of imagination, there is a seamless flow of credit. In fact, there used to be a seamless flow of credit earlier when there was no matching concept. This is another issue that is there with the concept of matching on the legality aspect. Another very critical issue that is going to come is the interplay of section 16 subsection 2 clause AA with section 16 subsection 4 of the Cgst Act. Now section 16 subsection 4 gives a time limit to take input tax credit. It says that you can take input tax credit only by next September. For a particular financial year, you can take input tax credit only by September of the next financial year. Which means if I have purchased goods, let us say in financial year 21-22, I have the invoice in financial year 21-22, I can take the credit by September 2022. There is no problem with it. But what is going to happen now with this amendment is that I can take the credit only when it is reflecting in Gstr 2B. Now let us have a situation that the supplier reflects this item in Gstr 2B only for financial year 21-22, only in September of 2022. Very much possible. We have seen that in a lot of businesses, especially small businesses, there is a tendency to upload and file the details of all the March and February, January related transactions by September so that everything gets properly audited. Which means you only have 1 month time to do the complete matching and take the credit. If I really do an interplay of section 16.2 AA with section 16.4, you are not getting 1.5 year time to take input tax credit. In some cases, if let us say the supplier is filing his GSTR 1 in October or November after the due date of September, before at all the credit becomes available to you, it becomes ineligible. Are you getting it? So credit, if I really harmoniously try to interpret section 16 subsection 4 with section 16.2 AA, the result that comes out is that the credit can become ineligible, credit can become unavailable to me without even it becoming eligible. So it becomes ineligible by the time even I could avail, which means there is no time limit to take credit. If the supplier uploads in October or November, although it may be reflecting, but my time limit to take credit is already gone. I think this totally makes section 16 subsection 4 null and void. In fact, the time limit of section 16 subsection 4 is, in my view, now actually not correct. It is not 1.5 year. it can be 1 month, it can be 1 year, it can be maximum 18 months, but it can come down to a time limit where there's no time limit for you to take credit also. So either two things must happen. Either we interpret section 16(4) harmoniously now, and we interpret section 16 subsection 4 that the time limit will be applicable right from the time first when it is reflecting in 2B. For example, in an example which I have given, let us say supplier uploads this transaction in November of 2022. So my time limit must start from November 2022 till September of 2023. This is how I need to interpret section 16 subsection 4 going forward. Otherwise, section 16 subsection 4's entire purpose of giving reasonable time for a recipient to take input tax credit is defeated. Or I would rather interpret it this way, that I will continue to take credit based on my books of accounts, whatever that is there, irrespective of whether it is reflecting in 2B or not. I need to make sure that on a later basis it is reflected in Gstr 2B. Rather than taking credit based on Gstr 2B, which is another interpretation that has to be made. And I'll come to that particular interpretation as well in the course of our discussion. Now, when I look at all these issues that are going to come up with this Gstr 2B coming in and all these new provisions coming in, it clearly goes against right to equality. And this is a Supreme Court judgment, a very landmark judgment. It talks about a provision being arbitrary. If a provision is arbitrary, more specifically, it is manifestly arbitrary, then even though it is a provision in a statute, even though it is there part of an act, still it is violative of Article 14 of the Constitution of India and unconstitutional. Landmark judgment of Shaira Bano. If you could just see the bold portion, when something is done which is excessive and disproportionate, such legislation would be manifestly arbitrary. We are therefore of the view that arbitrariness in the sense of manifest arbitrariness, as pointed out by us, would apply to negate legislation as well under Article 14. Same was brought by Supreme Court in Pepsi Foods. There are a host of judgments on Article 14. I don't want to really go into the details of this thing. You can't punish an innocent purchaser and treat them as equal to a guilty purchaser. That itself, is not an intelligent differentiation, which is categorically brought out in this judgment, which is there on the screen. KT Mupil Nair. Global Limited is another judgment. So there are many judgments on this aspect. Most importantly, it defeats Article 265 of the Constitution, where it says that no tax shall be levied or collected except by the authority of law. At the most, government can collect 18% GST on a transaction. Collecting 36% GST on a transaction itself is in violation of Article 265. It is in violation of the judgment issued by D.Y. Beetal in the case of Madras High Court, where clearly it says that if there is such mismatch, government must first collect this money from the supplier. Unless they are just not able to collect it from supplier, then they must come to recipient. In fact, now when I really look at this matching principle under GST law, I used to really criticize this Maharashtra VAT law. What is this nonsense of matching? And because no fault of mine, I am being penalized. And businesses ended up paying so much money. Every VAT assessment I see where businesses pay so much amount of money as mismatch. I used to criticize that. But after seeing the provision in GST law, I'm thinking Maharashtra VAT was so much better. It was a good law. It was a better law. It at least gave opportunity for 4 years, 5 years. You get it matched and no problem. We will give you the benefit. But in GST, after September of the next financial year, there is no mechanism. There is no mechanism to even match it after September. So let us say if there is a supplier who is paying the tax after September, or who you can give me a declaration that he has paid the taxes, government says we don't want to look at it. we will block your GSTR1. There is no mechanism to look at it after September. We will collect it from both supplier and recipient. Clearly violates Article 265. It is just a desperation to make GST completely technological savvy. This is all going to go under hammer for sure. Most importantly, the statement of objects is totally defeated. 122nd Amendment of the Constitution of India. If one goes and reads the statement of objects today, I would get a laugh at it as to what is that was the objective of bringing GST and what it has turned out today. So businesses are going to have tough time because now they are going to be a soup as to what do we do? Do we take it on legality or do we practically implement it and take that cost on ourselves? I'll deliberate on practically how do we really take this issue. So this is on the legal aspects or on the legality of this GSTR2B 16.2AA and the amended Rule 36.4. I am of a strong view that there would be a constitutional challenge which would be done. There would be assessees who would file, challenging 16.2AA, the legality of challenging 16.2AA, and I'm quite optimistic that this would come in the favor of assessees because of the various reasons that I've talked about in last 30 minutes. Maybe by then we'll come to know more reasons why there's a problem with this particular provision. However, as a consultant, I would never advocate or I would never give an advice to go after anything which is litigative, because businesses function on practical aspects. And only thing I wanted to just give you a flavor of what is the legal validity of this amendment as of today, in my view. Now, without going into the legality of it, assume that 16.2AA is valid, it is legal. Rule 36.4 is there to stay, it is legal. How do we implement this amendment now? That is what we will focus on now for the next few slides. First and foremost is that GSTR2A now does not have any relevance. What is to be looked at is GSTR2B. If ITC is matched as per GSTR2B, then there is no problem, because if it is matched, it is there in your invoicing books, it is also there in your returns. So it is matched and there is no problem as long as the ITC is matched. But then there are certain issues still that we need to look at, even when the ITC is matched with GSTR2B. There are businesses who are taking a call that even if it is matched in GSTR2B, still we will not take input tax credit until the point the supplier reports in GSTR3B and files GSTR3B. I'm talking about GSTR3B. This is the ultra conservative business stand many organizations, which is fair from their point of view, because nobody wants any litigation. But the important question is, do we really need to go and checking all those things? Do we really need to see that whether it's filed GSTR3B or not? In my view, answer is no. Because what Rule 36.4 talks about is only its reflection or communication in GSTR2B. One may point out section 16, subsection 2, clause B, and say, sir, it also says that the money must have been paid to the government, that is central government. What about that? Is it not a violation of section 16, subsection 2, clause B? Now, let me tell you, first of all, this section 16.2B and section 16.2AA, in my view, are not the preconditions to take the credit. These are the conditions to be made sure to be entitled to take the credit. So there is a difference between entitlement to input tax credit and availment of input tax credit. If we look at section 16, subsection 2, it talks about the conditions to be entitled to the credit. Now, when we look at those conditions, it nowhere talks, or it doesn't nowhere says that it must be a precondition to be taking the credit. So the important question here is, if let us say you are taking the credit based on Gstr 2B, you can always take the credit once it is reflecting in Gstr 2B on a post supply basis, on a post transaction basis. You can check whether the supplier has also filed Gstr 3B. Maybe this can be done every quarterly or every 2 months or every half yearly, and a particular communication can be made to the supplier with a final decision to be taken in September. And let us say if the supplier has filed Gstr 3B also, what is the guarantee or proof that you have that he has included your invoice and he has made all the payment, whatever that he has paid? You cannot know that. It is impossible merely by looking at the filing status. So how can a law expect, when there is no report coming out at a transaction level on the filing of, on the inclusion of your invoice in the Gstr 3B, a law cannot expect an assessee to do impossible. This is exactly what I told earlier, lex non cogit impossibilia, which is a very widely accepted legal maxim that law cannot expect an assessee to do impossible. So in my view, firstly, both these conditions are not preconditions. They are the conditions to be looked at eventually for entitlement of the credit. And in my view, one need not really dive into the Gstr 3B because law does not really expect an assessee to do impossible. However, as an abundant precaution, we can look at Gstr 3B filing status to understand whether the supplier is compliant, non-compliant, whether he is really making the payment of taxes to the government or not. That could be only an additional check. It is a good to have situation rather than a mandate of a law. So this is what I would have to say. But we need to agree, but we need to accept that there are businesses who are going to take a call that we will make a payment to you not just on reflection on Gstr 2B. We will also check your Gstr 3B filing status. Only then we will make the payment to you. So if you are delaying your Gstr 3B, be wary of this fact that your customer can stop the payment. Correct? Next, very, very important aspect is that you have taken the credit, it is matched, and that's why you have taken the credit. But later you have realized that the supplier has uploaded the credit note and reversed that transaction. Then what happens to your input tax credit that you have taken? Do you need to reverse that credit? And if you are going to reverse that credit, do you need to pay interest on that? And what is the mechanism for you to re-avail that input tax credit? Now, if you ask me really, there is no matching concept that is brought for credit notes. Matching concept is only brought for invoice and debit notes, which means taking credit, I will look at 2B, reversing credit, I will look at my books of accounts. So vague as it sounds, absolutely vague. It is going to lead to so many problems. Practically, how do I implement it? For taking credit, I will look at Gstr 2B, but to reverse credit, I will look at the books of accounts. My view, highly conflicting and is going to lead to a lot of problems. But then, as a business, we would have to take a call. How do we really go about it? If I have to give a more practical view on this, I would say whether you take credit or you reverse credit, refer to Gstr 2B. Don't follow multiple things. You will land up in big problems. So which means that if the supplier has later reversed the transaction by credit note, you would have to reverse the input tax credit. Because for all practical purposes, the tax has not been paid to the government, and you are aware of this fact because whatever credit he has passed on to you by 2B, it is reversed by credit note. So if there is a credit note in Gstr 2B, you need to reverse. Although legally we can always challenge it because I have already told you about the very provision of the act which has been there. Now, very important one point I would like to make here. At times, what we see that assessees, when they do the matching concept, they only look at taking credit. Matching concept is only mechanism to take credit. And they only match invoices or debit notes, but they don't match credit notes. Let me tell you, if you are not matching credit notes, you are going to invite a very, very big litigation in future. Because tomorrow government is going to say, look, you have taken input tax credit on invoice number 1011, and that invoice is already reversed by your supplier. It is reflecting in your Gstr 2A, 2B. How can you take credit? So what I see is that businesses, when they upload the details from the books of accounts, they upload only the details of invoices on which they are taking input tax credit. It is highly recommended we upload the details for matching of both the invoices on which we are taking input tax credit and also those invoices or credit notes which we have received from the suppliers. At times, these are passed as a debit notes in our books of accounts. Even that information must be uploaded on the portal for a proper matching. And if there is any transaction which is matched, where it is there in the books of accounts and it is also there in 2B as a credit note, you would have to reverse that input tax credit. Correct? So my suggestion is to do a matching of Gstr 2B also for credit notes, because otherwise, if you want to follow books for credit note and portal for invoice, it is going to be highly dangerous. I don't know how you would keep a track of it. So as a practical suggestion, we advise that you follow Gstr 2B even for credit notes. This is a scenario where it is matched. Now let us look at the next scenario where a credit is reflecting in ITC Gstr 2B, but it is not reflecting in the books, which means there is an input tax credit which is there in the portal, but you have not taken that credit in the books of accounts. Sometimes these credits mainly relate to airline bills, hotel accommodation bills, custom house agent bills, bank charges, employee reimbursements, so on and so forth, where businesses feel that it is kind of a pain to be taking that credit and having that thing, and at times it reflects in 2B. There are businesses who take a decision. September comes the September, and we will take all that credit in Gstr in our Gstr 3B, which is fine. But then, are you really in possession of these invoices? I'll tell you 9 out of 10 times businesses take the input tax credit of airline, CHA bills, bank charges and all these things, but they don't have any invoice in their possession, which is clearly in violation of one of the conditions of section 16 subsection 2. At the time of departmental audit, they are going to ask, please provide us the copy of invoice on which you have taken the input tax. And if you're not able to provide invoice, they can put up a case of fake input tax credit. It can clearly be a case of fake input tax credit, fraudulent input tax credit, and the penalties and the repercussions would be very large. So businesses who are taking bulk input tax credit in September must be careful that the September input tax credit does not come free just because it is reflecting in portal. It has to be backed by a proper tax invoice duly documented in your files. Very, very important. Next, very important aspect. If a particular transaction is reflecting in Gstr 2B and it is not there in your books of accounts, it is a beautiful case of you doing a deeper manual matching. I would say only relying on software for matching is highly dangerous. Highly dangerous. We don't know how you are matching. I have seen cases where people have done matching from financial year to financial year, from month to month. It's not a correct way of matching. Matching has to be done to date, till date. Matching has to be carried out with a spillover transactions also. There could be possibility of an invoice in the current year which was already uploaded previous year, or invoice of the previous year which is uploaded, invoice of the current year which would be uploaded in the subsequent year. So you would have to do 3 years at a time. spillover matching to really match. So what is the authenticity of the data that is going in the matching? So the moment there is an ITC which is reflecting in the portal and you are not having that ITC in the books, it means it calls for a deeper matching concept. Businesses, if you are thinking that we have a software to now match, let us upload the details in software and match it off, and whatever comes out will take only that much credit, which is fine. Software is really helping all of us. But my sincere suggestion is to have a system of manual matching. After you do the software matching, software will take care of your 90%, but that balance 10% you would have to put the manual efforts. I'll tell you one recent example of a client where there was 1.6 crores of input tax credit that was not reflecting in books, but was there in 2B. When we did the manual matching, when we asked client to do a manual matching, a good amount of about 5 to 10 lakhs was, they were able to take that credit. Well, let me tell you, 5 to 10 lakhs is a big amount. So that is a last mile squeezing of input tax credit that we must do by manual matching. How do we do manual matching, sir? We have so much less time between 14th to 20th. We need to file return on 20th. No problem. Don't do between that window. Do it after 20th and take the credit in next month. But there has to be a system of manual matching. Relying purely on software is dangerous because when we talk about input tax credit, it is 18% of gross. 18% of gross, the number can run into lakhs. And it's a very big value addition that you can do for your business, for your clients. Next, very, very important aspect is that if ITC is being taken based on Gstr 2B, it is reflecting in portal and it is not there in the books. It means there is something wrong with your internal control systems. What about your expense accounting? Whether at all there is a proper system of looking at as to how the hell this matching is going on. I've seen clients where the matching is not happening properly because the GST number system is taking from the vendor master. System is taking GST number for what is given in the PO and not from the actual invoice, which is leading to 20%, 25% mismatch. Put that system in place. Amend your vendor masters. Look at it as to from where the data is getting, flowing in your purchase register. That system is extrapolating. There are going to be delays in accounting. Many times it happens that the income accounting gets timely recognized, but the expense accounting gets delayed. So that could also be one root cause for mismatch. Delay in posting of transaction, lack of timely obtaining employee reimbursement bills, and lack of uploading the transactions bill-wise in the GST leading to mismatch. Vendor masters not updated, no vendor cleanup mechanism happening. In your master, the vendor's GST number is Maharashtra, and you are trying to match from Maharashtra, but your vendor is supplying you from Haryana and Tamil Nadu, and you are saying it is not matching. So your internal control systems has to be really revamped. In my view, every reason or a root cause of mismatch has to be gone into the detail of it. It must be fixed so that eventually 95 to 98% must get matched as a good practice. So that is where your internal control system strengthening is required. Deep review and sanitization of books. If you are going to pass accounting entries in a poor manner, don't expect great matching. It works. Let me tell you, any software works in a GIGO principle, garbage in and a garbage out. The moment you put a garbage, what you will get is also a garbage. So how are you accounting your input tax credits is very, very important. It is suggested to have the separate ledger for each GST number. Maharashtra, Haryana, within that Cgst, Sgst, IGST, cess. It may lead to tons of ledgers being created, but there's no way. You need to put that system in place so that the moment you upload, it has to get matched. Matching to be carried out for multiple spillover years, which I've already talked about. Next very important aspect is what about credit notes reflecting in 2B and not reflecting in books, which means credit note your vendor has uploaded in the online portal, but it is not there in the books. Why it is not there in the books? Maybe you have passed debit note. Many times it also happens that the accounts don't receive the credit note. The accounts department don't receive the credit note. They receive an invoice because you need to make a payment, but they don't receive credit note. Credit note will be uploaded. So you might have not even reversed. You might have not even passed an accounting entry for reversal, but it is reflecting in 2B. It means you need to reverse that input tax credit also. Of course, this is subject to the legal issue, which I already talked about. The next scenario that is going to come is ITC reflecting in books, but it is not reflecting in Gstr 2B, which means you have claimed that input tax credit, but your supplier has not uploaded that details till now. It is a non-compliant vendor. It is an unorganized player. They don't have funds, whatever reason, or he has uploaded, but as a business to consumer B2C transaction, or there is an incorrect detail. He has given different GST number, different value, different date, different tax. Just it is not matching. What is to be done in this case? Again, one is surely sanitization of your books. Is a very, very, very strong system of follow-up which has to be created now. Many people are taking a decision to hold the supplier payments. Accordingly, the PO terms and contract terms are being changed, which is a strategy which businesses are going to do. What is going to happen now is tons and tons of litigation is going to be created between the supplier and the customer. So possibly the litigation under GST and in civil courts will be more than the litigation in the GST tribunals. That is what I am expecting, because it's purely a business litigation that is going to get created. There are few suppliers or few customers who are debiting this amount to the suppliers. They are straight away debiting this amount to the suppliers. Now, in this case, one fundamental issue which is happening, we see that businesses debit the amount and they also take the input tax credit. This is a double benefit. There are Supreme Court judgments under the erstwhile law. If you are debiting this in tax amount to the supplier, then you cannot take the input tax credit. You cannot take the double benefit out of the transaction. Very, very important aspect. The third aspect could be you keep that ITC in the waiting list. You should have some provisional ITC ledger, and in a subsequent month up to September, you should keep on uploading this data for subsequent matching. This is one of the aspects that has to be looked at. Another aspect that can be looked at is to straightaway constitutionally challenge Section 16, Subsection 2, Clause AA, which I talked about the reasons how you would constitutionally challenge it, and go ahead and take the input tax credit based on books of accounts without looking at Gstr 2B. This would be highly litigative. Be ready for the show cause notice. Be ready for fighting this matter out in the litigation. If the values are not high, if the stakes are not high, I really don't recommend such approach. But if the stakes are very high and it is impacting your business as a business risk, as a working capital issue, then probably you should take a chance. So it has to be looked at on a case-to-case basis. One via media solution that can be looked at is to take the input tax credit, even if it is not matched, if it is there in your books of accounts, and don't utilize it. Don't utilize it, which means park that credit in your electronic credit ledger. There is no interest. Interest is not applicable. Section 50 is amended. But then there is only one catch in this problem. The problem is that you cannot hold GST in your electronic credit ledger pertaining to IGST. System wants IGST to be cleaned up first. So IGST will not be able to hold in your electronic credit ledger, but Cgst and SGST, even if it is unmatched, you can hold in your electronic credit ledger. Let us say after 5 years, there is one big player, Reliance or Larsen & Toubro, is going to file a litigation and they are going to get a favorable High Court or Supreme Court order. That time you utilize this input tax credit. Or you fight your own battle. And the moment you get a favorable judgment from a High Court or Supreme Court, that time you utilize this input tax credit. This, in my view, could be a more wiser approach where there is no cost, yet you can take the benefit of this entire scheme of input tax credit. Of course, if there is a credit note which is reflecting in the books but it is not there in Gstr 2B. It means you have reversed the input tax credit on a credit note, but the supplier has not uploaded this credit note. Then the important question that comes is, do you really need to reverse the input tax credit? Do you really need to reverse the input tax credit? Why I put this question is because maybe it is possible that the supplier has passed a financial credit note rather than a GST credit note, and you are unnecessarily reversing the input tax credit when the supplier has paid GST anyway on full 100 rupees. So if there is an input tax credit that you are reversing based on credit note in the books, which is not there in Gstr 2B, you should take a decision whether you need to really reverse that input tax credit. Probably a better communication with supplier has to be done. There are few more issues that are going to come. Although I told that Gstr 2A is no more relevant, but there is a circular 135 in the context of refunds, which still talks about Gstr 2A. Circular 135 till now is not amended. It does not talk about Gstr 2B. So maybe I expect government that the circular 135 would be amended in times to come. If it is not amended, then for taking credit, you need to follow Gstr 2B. And for getting refund, you need to follow Gstr 2A, which is again a funny thing. I hope that would not be the case. Do not delay the filing of Gstr 1, because if you are going to delay Gstr 1 filing beyond 13th, your supplier is not going to get input tax credit in that month. If you do it on 14th, it will be reflecting in the Gstr 2B of the next month. Then your supplier may hold the payment. So make sure that the returns are filed before 13th of Gstr 1, 13th of each month as far as Gstr 1 is concerned. Very important question, what is the timing of availing credit? When should I avail credit? The moment I got the invoice, should I avail the credit? Or only once it is reflecting in Gstr 2B, I must avail the credit. I am clear that you can avail the credit the moment it is there in you have the invoice. Because 16.2AA is not a precondition, it's a condition. However, practically, if you ask me, my recommendation would be to avail credit only if it is reflecting in Gstr 2B. Because if you are availing credit before it is reflecting in Gstr 2B based on the invoice copy, tomorrow the matter would go under litigation and the department may ask you interest for the early availing of input tax credit. So my suggestion would be to avail input tax credit only after it is reflecting in Gstr 2B, unless you want to challenge the wires of section 16.2AA and this entire matching concept. Interest applicability I've already talked about. So effectively, businesses have 6 days to do this entire matching concept, matching between 14th to 20th. On top of it, businesses want to file GST returns by 18th. So effectively, there are only 3 days, 14, 15, 16, for you to 3 to 4 days for you to do this matching. Perform software-based matching in this window, and after 20th, you need to do a manual matching system. Other issues, very critical issue is in the context of spillover transactions. A lot of questions are coming. How do we do for an invoice dated September 2021, but it is received now in my accounts, or it is received now in my expenditure ledger, or it is now reflecting in Gstr 2B. So how do I do matching for? Is this 5% buffer also applicable for invoice dated prior to January 1, 2022? Is all these spillover transactions related queries are coming? I'll make it very simple for all of you. You cannot get into the invoice date to be looking at taking the input tax credit, whether to look at following the old rule of 5% or new rule. The rule is applicable from 1st of January. It is applicable for you when you are availing the input tax credit. So when you are filing your return for December 2021 on January 11th, 2022 or January 20th, 2022, this particular provision is applicable. Gstr 2B is applicable. Don't get into checking, oh, this invoice date is September, I will take 5% extra on this. This invoice is January, I will not take 5% extra on this. Don't get into taking this 5% extra for your December return. In a very, very stricter terms. There would still be an issue with some cases where it will not reflecting GSTR 2B of January because the invoice was already uploaded by supplier in September. So it must have been reflecting in the GSTR 2A of September. Can I today take the credit while it is not reflecting in GSTR 2B, but it was reflecting in erstwhile GSTR 2A? No problem, go ahead and take the input tax credit. As long as it is reflecting either in GSTR 2B now or earlier GSTR 2A, go ahead and take the input tax credit. Nothing to worry on that aspect. We need to understand the principles rather than the unnecessary issues coming out of it. If you have reversed the credit and re-availing the credit, again, no problem. As long as it was earlier reflecting in GSTR 2A, no problem. You can go ahead and take the input tax credit. What to do with the additional buffer 5%? Do I need to reverse whatever additional buffer of 5% that I've availed? No need to reverse. Just make sure that whatever you have availed extra of 5%, 10%, 20%, that is adequately matched with supplier uploading the details in GSTR 2A. In a nutshell, you can actually also follow taking input tax credit based on books up to December 2021, and afterwards you can look at following strictly as per GSTR 2B, or of course after January again, if you want to follow books, it would be litigated. So there is clearly going to be a tiff between the supplier and the recipient that I see. The dominating party is going to be benefited out of this. So this is exactly what I brought in this particular slide. There could be various possible reasons for difference in GSTR 2B and 3B. I have quoted some differences. So what I'm trying to say is that this 2B matching is not required to be done on a month-on-month basis. It has to be an as-on-date matching that is required to be done. If you try to do month-on-month, these are the reasons why there would be difference. So it will not happen. It will never happen. This is in the context of input tax credit match mismatch. Now let me look at some other concepts. I have gone a little slow because I wanted to deliberate really in detail on this issue. So I think our today's discussion is up to 6 p.m. I think we may extend by 15 minutes. So please bear with me on this. Next very important amendment is blocking of GSTR 1. Rule 59.6 is been amended, which is also going to be effective from 1st of January 2022. What is the impact of this amendment is that if you are not filing the GSTR 3B for a particular month, your next month GSTR 1 will be blocked. In other words, if you are not filing the GSTR 3B of December 21 by January 2022, when you are going to file the GSTR 1 of January 22 in February 11, 2022, you will see that there is no option in the system for you to file GSTR 1. Your option to upload the details of invoices in GSTR 1 will be blocked. So there were businesses who were filing GSTR 1, but they were not filing GSTR 3B. All this practice is going to be stopped because system will not allow you to file GSTR 1 if you have not filed the preceding month GSTR 3B. This provision, in my view, is again arbitrary. It clearly goes against Article 19(1)(g), Section Article 301 of the Constitution of India, because there would be genuine problems with the business as far as the finances is concerned. There could be working capital issues. They don't have any wrong intentions of not paying the taxes. They will pay, but they don't have funds now, and that's why they're not able to file GSTR 3B. But somewhere government, I don't know whether they really know business, or I really don't know what goes in their mind while drafting some provisions of the law. Very dangerous, very draconian. On top of it, if you say, okay, I will upload the details in GSTR 1 and I will not file GSTR 3B. On the other hand, there is section 75, which is also amended, 75(12). Explanation has been added, saying that if a particular transaction or invoice is uploaded in GSTR 1 and you have not made the payment of that transaction, then it is a self-assessed tax. There is no question of government even issuing you a show cause notice. Straight away they can go for recovery. They can straight away attach your bank account. They can straight away go for garnishee proceedings or any other recovery proceedings directly without giving an opportunity of being heard. This is again going to have a large scale implications. We need to educate our clients. As a business, we need to understand that a difference between Gstr 1 and Gstr 3B under this explanation of section 75 can directly go for recovery proceedings and attachment of bank account. So we need to be wary of this. Let me tell you, similar provision was brought by way of Rule 86A, which is already challenged before various high courts. In my view, all these rules and unnecessary draconian provisions will be challenged. And we need to see how the courts are going to take it up. But somewhere I am not convinced with the lawmakers on what they are really trying to do. It seems there is absolutely no trust between the government and the taxpayers. Next, very, very important aspect is on the context of provisional assessment, provisional attachment. The scope of this provisional attachment is widened. Let me take it in a little quick manner. Basically, the commissioner has the power of provisionally attaching the property of the taxpayer. Let me just read section 83(1) for the benefit of all, where after the initiation of any proceedings, I have highlighted the word initiation of any proceedings because that is where the amendment has happened. Under chapter 12, 14 and 15, I've again highlighted that because that is where the amendment has happened. The commissioner is of the opinion, please pay attention. The commissioner is of the opinion that for the purpose of protecting the interest of the government revenue, it is necessary so to do. He may, by order in writing, attach provisionally any property, including bank account, belonging to the taxable person or any person specified in 122(1)(a), which could be your consultants or any person abetting the transaction in such manner as may be prescribed. Are you getting the wide powers which the commissioner have to provisionally attach your property even before there is any adjudication? Just they can start the proceedings, they can initiate the proceedings, and they can straight away attach. They can issue you ASMT 10 or they can issue you a letter and straight away attach your bank account. And what is required to attach? Commissioner needs to be of the opinion that it is required. Very, very wide powers given, draconian provision. And this is not what I am saying. This is what is told by Supreme Court in Radhakrishnan Industries 2021. This is a word used by Supreme Court. Can you see the second paragraph? The power to levy a provisional attachment is draconian in nature. The attachment will bring the business to standstill. Even the further collections will be affected. So this is something they are not realizing, but this is the law. So earlier, these attachment provisions were there only for section 62, 63, 64, 67, 73, 74. Now the bold highlighted, that is 59, 60, 61, 68, 69, 70 is added, which means even for a simple scrutiny of returns, they can provisionally attach your bank account. So we need to be very, very careful on these aspects. And this is basically to usurp certain high court judgments. And the word initiation is written because in the Radhakrishnan Industries, it was held that earlier the word was pendency of proceeding. After the issue of notice under section 73, the proceedings are completed. There is no pendency of proceeding. So how can you provisionally attach? So now they have removed the word pendency of proceeding and they have added the word initiation of any proceeding. So after the proceeding is initiated, before even the proceeding could be adjudicated, the commissioner, if it is of the opinion, they can provisionally attach for all these matters. Very wide power. Department has issued a guidelines. Basically, I would say anybody dealing in bogus invoicing, fake ITC, circular trading, it's high time. We need to change the tracks. We need to come in the organized economy. Otherwise, the repercussions under GST are high. The kind of data that the government is having is phenomenal. there is a team, or there is in fact a wing, which is only for analytics and risk management. So, and these are the High Court judgments that they have tried to now defeat by bringing this amendment. This is the judgment of Radhakrishnan Industries. I really do not want to go and read this judgment. What this judgment say in a nutshell is that commissioner must not use this power as a matter of routine. This must be done only as an exception, only when commissioner is of a serious opinion with a tangible material and an evidence that unless you are going to provisionally attach, the revenue is going to never get this money from the, or revenue will never be able to recover this money from the taxpayer. So on the similar lines, the guidelines are also issued by CBIC, but we know at times on the ground realities would be a little different. But then it is important that we understand that, you know, small mismatch in our returns can lead to larger consequences under GST. Then there is a amendment is brought wherein the procedure is prescribed that if there is an attachment done like this, how you can file the objection to this particular attachment. There was a time of 7 days. Within 7 days, you need to file the objection. That is now done away with, and objection must be filed, and an opportunity of hearing must be given before doing this particular attachment. Next, very important amendment in the context of detention, seizure, confiscation of goods, and conveyance in transit. Transportation industry must be now understanding the implication of this amendment very, very clearly. This is in the context of e-way bill. So what was happening is that in the case of e-way bill, if the vehicle was, you know, stopped in the transit due to various reasons, the officer was levying tax and penalty, 100% tax and 100% penalty. Then a lot of writ petitions were filed that if the tax is already paid, why again you are charging tax? And you know, it's a double taxation. In fact, we also have filed quite appeals on this matter. There's a double taxation. So now to avoid this double taxation, they have amended this provision, and instead of 100% of tax and 100% of penalty, they have made 200% of penalty, which means if you are goofing up or doing some contravention or some error in your e-way bill, not generating, not timely generating, incorrectly generating, it can lead to 200% penalty, which is penalty is equal to 200% of the tax. Let us say you are moving the goods worth 50 lakhs and the tax is 9 lakhs, and there is some problem with the e-way bill on this matter, then your penalty is going to be 18 lakhs. So on the goods of 50 lakhs, you will end up paying tax plus penalty of 27 lakhs. That is when you are coming forward to make the payment of tax. If you are not coming forward to make the payment of tax, then tax can actually go up to 50% of the value of goods. Absolutely high implication. I think e-way bill is one area where you need to have your systems in place. Although it is very draconian provision and a lot of High Court judgments are coming in favor, but that is coming at the cost of litigation. Nobody wants to litigate. So something that we need to be wary of. There is a lot of people who are saying that earlier when the vehicle was being stopped, there was a system of bond and bank guarantee, which is now done away with by way of this amendment. I would not agree, because Clause C of Section 129(1) is still in place. The circular which was allowing this mechanism of releasing the goods based on bond and bank guarantee is still in place. So the mechanism of releasing the goods being based on bond and bank guarantee is still there, in my view. However, one draconian provision what they have now brought is that in case of e-way bill matters, you need to release the you need to make the payment of penalty within 15 days. The notice will be served within 7 days. And if you are not replying to the notice or whatever you are replying to the notice, the order will be issued in another 7 days. So in matter of 15 days from the time of the detention of the vehicle, the order will be issued and the adjudication will be done. The important question that comes is it a reasonable opportunity of being heard? So we need to understand that as a principle of natural justice, it's not just about giving an opportunity of being heard. It is about giving a reasonable opportunity of being heard. In my view, 15 days for a vehicle stuck somewhere in the remote location, you are giving only 15 days to a taxpayer to reply to a show cause notice and also to file an appeal. I don't know. Especially when there is 3 months plus 1 month, 4 months time given under section 107. So how do I harmoniously interpret 107 with this particular provision? In fact, it clearly defeats 107. And if you're not making the payment of penalty within 15 days, then the department has a power to auction your goods, e-auction your goods, and sell it off in the market and recover the tax dues and penalty. If the goods are of hazardous nature or of perishable nature, they can do it even for a time below 15 days as well. Transporter is given. Let me tell you, by way of this amendment, even transporter's vehicle can also be detained. The conveyance can also be detained. And till now, if the main person's proceedings are completed, the proceedings relating to transporter was deemed to be completed, but now that is delinked, which means transporter will have to fight his own battle. The supplier or recipient will fight his own battle under e-way bill. Now these are made two different proceedings. So transporters are going to face problem in their vehicles now being detained under e-way bill, and the same auction proceedings, all those things are there. However, in case of transporter, they have given an option of paying 1 lakh rupees as a penalty to release the vehicle provisionally. This is 1 lakh in Cgst, 1 lakh in Sgst, totally 2 lakhs. This is what I talked about. You need to make a payment of 25% of the penalty as a pre-deposit to be filing an appeal for this matter. And one good thing that has happened is the confiscation proceedings under section 130 are delinked from section 129. So only the ingredients of section 130, if they are present, that is, if there is a fraudulent transaction or an intention of evasion, only then confiscation can happen. Otherwise, there is no confiscation. Confiscation means basically the title gets transferred to the government immediately. Yeah, and this is a procedure which is prescribed for you to, recover or get the material released in case it is detained. I'll not go into the details of the procedure. So this is another critical amendment as far as e-way bill is concerned. Now let us look at some other critical amendments. One is mandatory Aadhaar authentication. Since we know that a lot of fake invoice, fake credits, fake refunds have been floating across the news, what government has done is that to verify the genuineness of the person claiming the refund or verify the genuineness of the person being registered under the GST law, in all cases where a person is filing a refund application either under LUT without payment of tax or without LUT with payment of tax, you need to get the mandatory Aadhaar authenticated on your GST portal. And this is the path through which you can follow dashboard, my profile, and Aadhaar authentication status and get this Aadhaar authenticated. Obviously, you need to get the Aadhaar number is not there for a company. So in case of company, the director, in case of partnership firm, the partner, proprietorship, the individual, whomsoever is a concerned person in charge needs to get his Aadhaar authenticated. This is in the context of revocation of cancellation of registration, or in the case where you're filing the refunds. Please get this done immediately because this is also effective from 1st of January 2022. And if you're not getting this Aadhaar authenticated, you may see your refunds being blocked. You will not get the refunds for your exports. Very important, if you don't have an Aadhaar number, then please submit the Aadhaar enrollment slip with any of these documents, election ID, voter ID, passbook, or whatever, and get your Aadhaar number within 30 days is what it is exempted for, a person who is not a citizen of India, government, local authority, public sector undertaking, all these persons. Other key amendment, yes, extension of filing of GST 9 and 9C. Now the time is given up to February 28, 2022. So professionals, businesses would now have adequate time to file GST 9 and 9C. Then there is, yes, very important is the periodicity of filing of ITC 04. ITC 04 is an intimation to be filed in the context of job work. This was required to be filed every quarterly. Now this quarterly time limit has been made to half yearly, if the business is having an aggregate turnover of more than 5 crores, and yearly if the business is having an aggregate turnover of less than 5 crores. It is a welcome amendment because filing this ITC 04 was a pain. My worry is that whether even half-yearly, whether you will be able to file when you are just not able to file it in the first place. So that is something we need to figure out. But then still quarterly, half-yearly is better than quarterly. So it's a welcome amendment. But then let me tell you, this amendment is effective from 1st of October 2021 rather than 1st of January 2022. Entire discussion that I'm doing today is effective from 1st of January 2022. Only those cases which are effective prior to that, I have specifically mentioned in the slides. There was a time limit to file there was actually earlier no time limit to file the refund claim in case where Cgst, Sgst is wrongly paid as IGST or vice versa. In fact, you could even file the refund claim for July 2017, in 2021. So government realized this anomaly, and September 24th, 2021, they capped it that the time limit for refund is only 2 years, even in cases where Cgst, Sgst is wrongly paid as IGST or vice versa. Next very important aspect is Anti-Profitering Authority. The term of Anti-Profitering Authority is extended by 1 more year. That is, it was supposed to be ended by November 30th, 2021, which is now extended up to November 30th, 2022. This is what they are doing every year. Every year they will amend it by 1 more year because they are seeing that Anti-Profitering Authority is doing a wonderful job. And they are able to recover phenomenal amount of money without having any constitutional backing, and they want to take an advantage out of this, and they are extending this time limit. Maybe we'll have another amendment coming in November 30th, 2022, but it is extended by 1 more year. Correct? So not right as far as businesses are concerned. One very important amendment is an updation in the Hsn coding system. Please pay attention that Hsn coding system, as we call as harmonized system of nomenclature, is something that is internationally recognized. It is something that is provided by World Customs Council, where multiple nations are member to this particular international trade body, and whatever the Hsn coding system is issued by the World Customs Council is adopted by India at an 8-digit level. Now this 8-digit level is now amended by the World Customs Council, and this is also adopted by the customs from 1st of January 2022, which means you would have to revisit your Hsn code from 1st of January 2022. This can have an implication under the GST Act because GST Act has directly applied or referred to the Hsn coding system of customs. And it could be possible that currently you are classifying your product under residuary code. It would go under the general specific code. Let me tell you, this amendment has no implication for service sector. This is only for goods, and it would also have an implication under your ROTEP scheme, whether your ROTEP benefit may get changed. It may also have implication on the rate of tax under GST. Once you are going under the specific heading, whether your tax rate would get changed. This is more specifically for the food industry, because I see that in the food industry, a lot of people classify under 2106 as a residuary item. So that is very, very important. It would also have an impact on the exemptions and benefits that you were claiming under customs, because under customs, various benefits and exemptions were driven based on your Hsn code. And also it would have an impact on the very rate of tax that you have adopted under customs. So it is highly recommended for businesses to revisit all their existing Hsn codes based on this particular change that has happened. Now we are done with the general amendments applicable to all. We would now be discussing on certain amendments that are sector specific. Just give me a minute. So as far as sector-specific amendment is concerned, first is on the concept of mutuality. This is applicable for associations and clubs. Now again, this amendment is retrospectively made from 1st of July 2017. It's a retrospective amendment. Government was trying hard to levy service tax on association and clubs, and unfortunately they were never able to do it, because earlier there was a Jharkhand High Court judgment in the context of Ranchi Sports Club, which was against the department. Then recently there is a Calcutta Club Supreme Court judgment which has settled this issue under service tax, pre-negative list regime and post-negative list regime, that association and its members are one and the same. There is no interstate supply of goods or services between the association and their members. For example, your Rotary clubs, your Lions clubs, your Red Cross societies, your housing societies, BNI, all these association clubs, golf clubs, and all these things. It was held that in case of this, associations, it is all for one and one for all. Member is not separate from the association. Association is not separate from the member. So there are no two persons. And to levy a tax, there must be two persons. Now they have amended retrospectively Section 7 of Cgst Act, wherein clause AA is being brought, specifying that the activities or transactions by a person other than an individual to its members or constituents, or vice versa, for cash, deferred payment, or other valuable consideration is deemed to be supplied. And the explanation says, for the purpose of this clause, it is hereby clarified that notwithstanding anything contained in any other law for the time being in force, or any judgment, decree, or order of any court, tribunal, or authority, the person and its members or constituents shall be deemed to be two separate persons, and the supply of activities or transactions inter se shall be deemed to take place from one person to another. Unfortunately, the implication of this amendment is very, very wide. If you see this amendment, nowhere it uses the word association or club. It says a person and its members or constituents, which means that the stretch of this amendment is beyond association and club. What do you mean by person and its members? What do you mean by person and its constituents? Does the implication of this amendment also extend to a partnership firm, where the partner is doing something for the firm and the firm is doing something for the partner? Does this implication extend to joint ventures, where a member of a JV partner is doing something for the JV and the JV is doing something for the JV partner? I am scared, because this is now going beyond association and clubs, and it is going to again lead to a bigger litigation. The fact that whether at all this amendment would apply for association or clubs, I'm sure that this aspect would further be constitutionally challenged under various provisions of the constitutional law. But then this is a long drawn litigation, what we need to understand. So what is recommended for associations and clubs is to better start collecting the taxes from members and paying the taxes to the government of India and state governments, Cgst and Sgst. If you have not started doing, please take registration and start paying it. If you're a housing society, you get the benefit of 7,500, and you need to pay only on the value which is beyond 7,500. Up to 7,500, there is an exemption for housing society. The only issue that comes is that this is applicable retrospectively. So what happens to the interest for the past? Whether interest is applicable for the past, in my view, interest should not be applicable for the past for a retrospective amendment in the Act. I have quoted a couple of judgments of Supreme Court for this aspect. Availability of input tax credit for the past is doubtful because the time limit is already over for that. But then that is also something that can be challenged on the availability of input tax credit for the past. Constitutional challenge, as I've already told, would again lead to a long stand battle if you're trying to take that particular view. But in my view, that would also be challenged, and we would have another litigation on the same aspect, which has taken 15 years under service tax. We will have another 15 years on the same point, the litigation, and we will have Supreme Court telling us somewhere in 2030-35 on the constitutionality of this amendment under GST law. Next is passenger transportation service through e-commerce operator. Now, what they have done is that we need to know that when you are booking a cab, Ola or Uber through an app, that is, so the liability to pay tax is shifted on the Uber or Ola as an e-commerce operator under Section 9, Subsection 5 of the Cgst Act. This restriction was not there for omnibus, so they have added the word omnibus. Omnibus is basically a bus having a larger seating capacity, I would say more than 6 as per the Motor Vehicles Act. So even for buses, if they are being plied for transportation of passengers through a software or a platform or an e-commerce operator or an application, the liability to pay tax will not be on the transporter. The liability to pay tax will be on the platform. It is an operator, e-commerce operator. So by the amendment, first thing they have added omnibus. Second thing, non-air conditioned contract carriage. That is all your non-AC buses that were plying, let's say, for example, Kesari Travels or your Sangeeta Travels and Nita Travels, whatever kind of travel agency with a non-AC bus was exempted till now. And the benefit of this exemption was also taken by the platform, that is Redbus, Make My Trip, were also taking the benefit of this exemption. The government realized that anyway the liability of tax is on Redbus or Make My Trip, then why we should give the exemption to such big players? Because any reason for this exemption was to protect small players. And that's why if the transportation of passenger is going to be done through an e-commerce operator, then there is no exemption. So this is for the non-AC bus of contract carriage, stage carriage, and metered cabs and auto rickshaw also, including e-rickshaws. So now GST is applicable even on auto rickshaw passenger transport services. If you are directly paying the auto rickshaw driver, then there is no GST, it is exempt. But if you are booking the auto rickshaw through a mobile app, that is Ola or Uber or any other application, then that Ola or Uber is going to pay tax on the transaction either at 5% or 12%, as the case may be. Since I want to understand all with fuel transactions, it would lie under 5%. Uber has already filed writ on this matter, challenging the constitutionality and right to equality on this particular aspect. The matter is listed, but as of now, there is no decision of the Gujarat High Court on this, sorry, Delhi High Court on this matter. But Uber, I think, has started paying GST on this matter. Now, this is very funny incident happened with one of our office person. That is, unfortunately, when we were trying to look at booking an auto, the fare of auto was more than the fare of a cab. And this is, I would say, about 2 days back. So we were seeing that in Uber in Pune, it's very difficult now. It has become very difficult to get an Uber to a cab. And as far as auto is concerned, you get it in like 1 minute or 2 minutes. It was very fast. So a lot of people started, flying through auto since it was quite convenient and easily available. But then it's a big bumper bonus which the government has targeted, and I'm sure it is going to lead to a high revenue for government by targeting these platforms, even for auto rickshaw and e-rickshaws. But the unfortunate thing is the price of auto is more than the price of a cab. So that was very strange for me to even look at. I'm still not able to understand why that difference is there. Maybe GST could be one aspect. Next amendment, one important thing I would like to bring out, that this amendment is only for passenger transportation. We need to understand that Uber also does goods transportation by way of Uber Eats. Ola also does goods transportation. I think Ola Instamart. So this amendment is not applicable for goods transportation. It is only for passenger transportation. In case of goods transportation, the respective supplier will pay GST. For passenger transportation, the liability is shifted on Ola or Uber. Very, very important. What happens to players like Dunzo? Because Dunzo would do both passenger and goods. What happens to Rapido? Now, I don't know. It's tough. How do you really figure that out? So now restaurant supplies through e-commerce operator. This is another big change for a restaurant. I think as far as the restaurant industry is concerned, again, very unorganized sector. It has been seen that restaurants do take registration, but they don't pay the taxes. Even though despite the rate of tax being 5%, while they are collecting the taxes, they don't register. So restaurant government saw a big ticket chunk that is getting missed over there. And now as the businesses are moving towards digital, that is, platform based supplies directly going to the B2C through a platform, government thought, why to tax a restaurant? Let's target Zomato, Ola, and Swiggy. And I think now many people are doing this business. So effective 1st of January 2022, if you are ordering any food from Swiggy, Zomato, and any of these applications, the tax on that food restaurant service would be collected and paid by the e-commerce operator and not the restaurant. This is the rule. So till now, let us say you ordered a biryani through a Swiggy, you would have received two bills. The bill of the restaurant charging GST on the biryani and a bill of Swiggy charging GST on the delivery charges. But now you may or may not get a bill of restaurant because there's no tax invoice to be given, but you will surely receive a bill of Swiggy charging you GST on both biryani as well as the delivery charges. But there is one catch here. Government says that we do not want to target all the restaurants. We only want to target small restaurants. And they did a bifurcation. If there is a restaurant which is situated in a premises where the hotel accommodation is having a room tariff of more than 7,500, then in that restaurant, the tax will be collected and paid by the restaurant, not by Ola, Swiggy, Zomato. Very confusing. Now just imagine if there is a restaurant in Marriott, then that restaurant will have to collect and pay GST, even if it is supplying through platform. If a restaurant is there in a street, then the Swiggy will collect and pay GST. I really don't understand. You could have done one way, either let's do everything through platform or let's do everything through restaurant. Why to have all this? No, then again we'll make class, this class, that class, all confusion and interpretational issues that are going to come. What is going to happen with a restaurant? Let us say there is a restaurant which is having one outlet in Marriott, which is a 5-star, 4-star or 5-star. In that outlet, whatever sales that they are doing, they will have to collect and pay GST. And let's say the same restaurant is having one more outlet, but outside of the hotel, somewhere in some good posh location. For that outlet, whatever sales that they are doing, the Swiggy will pay the GST. Fantastic. Fantastic. Funny as it sounds. But then this is the law as amended. Now let us look at section 9, subsection 5 of the Cgst Act. It says that intrastate supplies of which shall be paid by the electronic commerce operator as if he is the supplier liable for paying the tax. So on this transaction, the liability to pay tax is shifted on the e-commerce operator as if he is the supplier liable for paying tax. Let me tell you, the levy is not shifted. It is only a mechanism of payment of tax, or the liability of payment of tax is being shifted. This is exactly like a reverse charge, but rather than reverse charge, I would call it as a specific charge, where rather than charging the recipient, it has been charged on some third person. But for all practical purpose, this is like a reverse charge only. Correct? Now there are some catches that we need to understand here. One is that this amendment is applicable for restaurant service. Restaurant service. So what happens if a restaurant is also selling some goods along with the restaurant service? Very much possible. Let us say there is a restaurant which is also selling some biscuit, some bakery items, some packed food, some chips packet, some salad box, some MRP products, some ice creams, packed ice creams. Is it a sale of goods or is it a supply of service? That itself is a big time litigation under GST. What do we do? It's a sale of goods or a supply of service? If it is a sale of goods, government has clarified by way of a circular that if a restaurant is supplying ice cream which it has not cooked by itself and done some little bit of work on this ice cream has given, then it is a sale of goods. This is what is clarified by CBIC. My worry is if a customer is going to order a thali with an ice cream, on the thali, Swiggy will pay GST. On the ice cream, restaurant will pay GST because this amendment is applicable only for restaurant service. It is not applicable for the sale of goods. On the same bill, the transaction liability is on two different persons. Again, very funny as it sounds. I really don't know whether this has been overlooked or it is ignored or it is intentionally done. I don't know. This has to be fixed. Now what Swiggy has done? I've seen a message Swiggy has sent to its its restaurant partners. Please tell us whether you are a restaurant or you are selling goods or you are doing both. They've asked all. They have categorized all their partners in three buckets. One is restaurant, other is non-restaurants, and third is hybrid. So if you are a restaurant, then Swiggy will collect and pay the tax. If you are only doing sale of goods through the Swiggy platform, then the restaurant will pay the GST with Swiggy deducting the TCS. And if you are hybrid, then please give the Hsn code. So based on Hsn code, we will decide whether it's a service or it's a goods and accordingly decide the taxation. If you don't give us anything, we will assume that it is a restaurant. So it could be possible on the same transaction, Swiggy is also paying and restaurant also paying the GST. Nutshell of all these things is that if you are going to restaurant and having a food in dine food, then restaurant will pay GST. Restaurant will collect and pay GST. Same restaurant, if you are ordering through app, Swiggy will collect and pay GST. If it is a takeaway, if you are going and collecting, restaurant will pay GST. If it is a takeaway, again, whether the restaurant is cooking or now cloud kitchen and central kitchen, whether it is a sale of goods or service is a different issue. And if it is a home delivery, if the delivery is done by restaurant themselves, that is, for example, Pizza Hut and Domino's, they have their own delivery system, then the restaurant will pay GST because still it is not through someone else's app. If it is through your own app, then this provision is not applicable. It means still Pizza Hut or Domino's will collect and pay GST. But if the home delivery is through some other's platform, then that other platform will pay GST. I am worried if all these situations are there for the restaurant, what is going to happen? I don't know. Very important question comes is that let us say a restaurant is having a turnover of 50 lakhs, 35 lakhs is sold through platform and 15 lakhs is sold through Swiggy. Whether the restaurant is required to take registration? In my view, yes, because this supply is not an exempt supply. It is also a taxable supply. Just that the tax is paid by someone else. And I don't recommend anybody to, not take registration in this aspect. So we need to understand that the section 9, subsection 5 is shifted for limited purpose. That particular has been treated as if he is a supplier for a limited purpose of paying the tax and not for other purposes, especially for assessments and all these things. So in my view, it would still be considered as a taxable supply and restaurant must take registration if their turnover, including the platform, is exceeding 20 lakhs. Who will raise the tax invoice? Tax invoice will be raised by the platform, not by the restaurant. In case the platform is collecting and paying the tax, whether supplies through e-commerce operator be considered as exempt supply for the purpose of reversal of ITC, not as an exempt supply, but still restaurant will not be eligible for input tax credit by virtue of a restriction brought under the rate notification for the restaurants when the tax is at 5%. What about composition scheme? Even if the restaurant is under composition scheme, as far as Swiggy or Zomato is concerned, they need to charge full GST at the rate of 5%. The liability, tax liability or tax position of Swiggy or Zomato will not depend on the status of the restaurant. Even if the restaurant is unregistered, Swiggy or Zomato would need to collect and pay GST on this transaction. The funny thing was, how do we disclose a restaurant? How does restaurant disclose this transaction in the GSTR 1 and GSTR 3B when they're supplying through platform? It has been mentioned that you disclose this as an exempt supply. If I really read the meaning of exempt supply, it's actually not an exempt supply, but this is what they have mentioned. Disclose for the time being. You will have an amendment coming in GSTR 1 and GSTR 3B. A special category will be created for these kind of transactions. What is the impact on e-commerce platform? They would have to deduct TCS in some transactions. They would not have to deduct TCS in some other transactions. That is what they need to do. For example, in case of supply of goods, in case of these all 5-star hotels when they are dealing with, or some goods when they are transporting, delivery packing and all those things. Mandatory registration is required for e-commerce platform. Most importantly, as I've told, even the restaurant is unregistered, they need to do this. Whether the e-commerce is required to reverse the tax proportionately on the input services, the answer is no, because they're not taking any credit in the first place on the goods or services what they are supplying. So there's no question of reversing any input tax credit by the e-commerce operator. Whether the e-commerce operator can utilize input tax credit, in my view, yes, they can utilize input tax credit. Department circular says that they cannot utilize input tax credit and they would have to pay the entire amount in cash. I don't agree with this view because there's no provision restricting such particular payment of money in cash. But then as an abundant precaution, platforms can better pay this money in cash because the circular clarifies this. Important question that comes is, when the platform is now levying 5% GST on the restaurant service and delivery charges is at 18%, whether it is a composite supply and even on the delivery charges, whether they need to pay GST at the rate of 5%, in my view, no. On delivery charges, the platform would be required to charge GST at the rate of 18% because this particular supply is not a supply by the e-commerce platform. E-commerce platform is only paying the tax for the limited purpose of paying the tax. They are supplier and they are not the supplier per se for this transaction. So this is not a composite supply being bundled. These are two different transactions supplied by two different persons, and hence on the delivery charges, the tax liability continues to be 18%, although there are divergent views with few professionals taking a view that on delivery charges, the rate would be 5% as a composite supply, although I have got a different view on that. All the commission charges, packing charges, whatever other charges which the e-commerce platform does, it would continue to be at 18%. Disclosure would be taxable supply in Gstr 1 and 3B. And based on Hsn code of the restaurants, the implication would be on the e-commerce platform. God forbid if the restaurant has given an incorrect disclosure to the e-commerce platform, tomorrow the liability of tax will come on platform and not the restaurant. Next very, very important amendment is in the context of governmental projects. Let me quickly run through this amendment. Government, when certain works contract supplies are done for central government, state government, union territory, local authority, governmental authority, or governmental entity, the rate of GST was on a reduced rate of 12% or 5% or exemption in some cases. This is mainly for bridge works, road works, water works, various other infrastructural, canal, dam, irrigation projects, earthwork. This benefit was given. Very unfortunate that now government, by way of an amendment with effect from 1st of January 2022, if the supply is made to government authority or government entity, then this benefit is not there for certain supplies. Which means, what is government authority or government entity? Government authority or government entity is not government in per se, but they are the entity or authority which is 90% controlled by way of equity or other participation by the government. In all these cases, generally the work comes through tender, and the businesses were allocated the work. The biggest problem that is going to come at times is that the tenders are floated and the bids are submitted all inclusive of taxes. Let us say a bid is submitted for 300 crores, all inclusive of taxes, assuming that the tax rate is 5% or 12% or is exempt. Suddenly, now you come to know that in that same transaction, you need to pay 18% GST. This is very dangerous for all the government works. I'm sure there will be a representation that will go on this matter, and government would have to amend this particular provision. Now, what is government authority, government entity? I'll give you some examples. Let us say CIDCO or Tamil Nadu Generation and Distribution Corporation, Kochi Metro Rail, Tamil Nadu Water Investment, Amravati Metro Rail. So all these, when you are supplying to these entities, it was at a concessional rate, which would now be taxable at 18%. What were the transactions that were exempt? If you see any services which are a function entrusted to a municipality or panchayat under Article 243G or 243W as a pure service, or 75% of service in a transaction, it was exempted. It was exempted, mind you. It will now be taxable at 18%. And if it is a cum tax contract, the contractor or the subcontractor would have to take the load of this entire taxation. Next is construction works contract for historical monument, archaeological sites, canals, dams, irrigation works, pipeline, conduit, water supply, water treatment, sewage treatment plants and disposal, sewage disposal plants. All these were taxable at 12%, which will now be taxable at 18%. The subcontractor, when it was supplying to the main contractor, it was also taxable at 12%, which would now be taxable at 18%. The problem that is going to come is that who is going to take the load of additional 6%? Because the tender which was floated was all inclusive. And most importantly, the fight is going to happen between a main contractor and a subcontractor on the taxation. Same issue is now going to come for hospitals, educational institutions which are constructed for the government. and other civil structures which are not used for business purposes. And the same issue is now going to come for the earthwork transactions, because in case of earthwork, the tax rate was 5%. This 5% will become 18%. All these infrastructure companies would have to seriously assess the viability of continuing the project if they are not going to get the GST extra from the government authority or government entity, because generally the businesses run in a margin of 5 to 10%, at time even in losses, because to get a big contract, people do quote at a very lesser prices, which would add value for that business in the future. On top of that, now if somebody is to asked to pay additional 6%, 13% or 18% of GST, it is going to hit them hard. So first and fundamental, whether to continue the project has to be looked at. The presentation must be made before the government authorities to get the taxes extra, despite not being part of tender. Try to generate the RA bill for the work done up to December 2021, so that to that extent there is no taxation. Procurement planning has to be revisited. Most importantly, if you are falling from exempt to taxable, then you can now take the input tax credit of all the stock which was lying as on 31st December 2021. Most importantly, if you have purchased some capital goods, machines, tractors, excavators, on all this, you can, even if the capital goods was purchased in 17-18, you can proportionately take the input tax credit on that. This is very, very important, because this has happened in the case of transport industry, where many transporters moved from 5% to 12%, and they have taken the credit of all these vehicles that they have purchased. The time limit of input tax credit does not apply in these cases. So this is very, very important that the contractor must know to actually take the input tax credit for the past even 5 years. How the taxability is going to work on spillover transactions is based on 2 out of 3 rule. That is 3 things to be looked at: when the advance was received, when the invoice is raised, and when the service is provided. If 2 out of these 3 things have happened in December 21 or prior to that, then the old rate will apply. If 2 out of these 3 things have happened in January and after that, then the new rate will apply. So again, in this aspect, I felt that this is a very, very draconian amendment. You need to first look at whether you are falling in this amendment. Is there any other entry under which you can still continue to take the exemption? If not, then you need to change the rate of tax, and highly recommended to file a representation before the ministry and the authorities. Textile and footwear industry. They have brought the change in the textile products, ready-made garments, saris, apparels, woven fabrics, blanket, footwear, where the tax rate was rationalized and increased from 5% to 12%, 12% to 18%. But I don't know what has happened. Suddenly on 31st December 2021, the GST Council meeting was called upon, and they told that all the rate increase what we have done in textile, we are taking it back. Maybe there must have been a very big resistance from the textile industry. They must have got a really good lobby, and they were able to convince government not to levy the extra tax on the textile. So this amendment was brought and later also removed. So very important, textile products, as on today, 1st of January, there is no rate change that is happening. Unfortunately, I don't know, but they not extended this benefit to footwear industry. So all your footwears up to less than 1,000 rupees, the tax rate was 5%, which is now increased to 12%. So footwear less than 1,000 rupees would now be taxable at 12% effective 1st of January 2022. So these are a few sector-specific amendments which I thought are important. So with this, we conclude our discussion on today's topic. I looked at covering both from a practical aspect as well as from the legal aspect, both on the point of sector-specific issues and general issues per se. So we can now